62. That's the number tattooed into the American retirement psyche, like a finish line. The moment the government says you're allowed to collect. The year most people start counting down to as soon as they hit their 50s. And here's the thing. In 2026, roughly 1 in 5 Americans still claim Social Security the very first month they're eligible at 62. Not when they need it, not after careful analysis. The first month, like showing up to an all-you-can-eat buffet at 10 in the morning before they've even turned on the heat lamps, because technically the doors are open. Here is what that decision actually costs. The difference between claiming Social Security at 62 versus waiting until age 70 is $2,212 per month, according to the Social Security Administration's own 2026 data. That's $26,544 per year, every year, for the rest of your life. And if you're an average 62-year-old man, that rest of your life is potentially another 2 decades. This video is going to walk you through exactly 4 layers of why age 62 is a trap. And I'm going to do it in a specific order because the 4th one is the one the retirement industry genuinely does not want you thinking about. By the end, you'll have a framework for making the actual decision, not the emotional one. Let's go. The central metaphor I want you to hold on to throughout this entire video is a hotel reservation. Imagine you've booked a hotel, and the standard check-in time is 3 in the afternoon. But the hotel has a policy. You can check in at noon if you want, but the room you get is 30% smaller. Same hotel, same view, same amenities on paper, 30% smaller room, permanently. You can't upgrade later, you can't switch rooms, and every single night of your stay, you're living in that smaller room. That's Social Security at 62. The bed is smaller, the bathroom is tighter, and when your spouse visits for the rest of their life after you're gone, they're also stuck in that smaller room. Keep that hotel in your head. We're coming back to it. Now, in a few minutes, I'm going to show you something about the healthcare math at age 62 that most retirement calculators refuse to compute. But first, let me show you the raw math of what we're actually talking about, because the numbers are more brutal than the headlines suggest. Here's the official Social Security structure as of 2026. If your full retirement age is 67, and that's everyone born in 1960 or later, claiming at 62 gives you 70% of your full benefit permanently. The SSA reduces your benefit by 0.05% for each of the first 36 months before your full retirement age, then 0.05% for each additional month. Over 60 months, 5 full years, that math lands at a 30% haircut. Not a temporary one, not one that adjusts when you turn 67, permanent for life. Now run the actual dollar math. The SSA publishes the maximum monthly benefit at each claiming age for 2026. At age 62, $2,969 per month. At full retirement age of 67, $4,152 per month. At age 70, $5,181 per month. The gap between 62 and 70 is $2,212 a month. That's not the gap between bad planning and great planning. That's the gap between the same person making one decision versus a different one 8 years apart. But I want to use more realistic numbers because most Americans are not maximum earners. Let's use a common example from the financial planning world. Say your full retirement benefit at 67 would be $2,000 a month. At 62, you'd receive $1,400. At 70, you'd receive $2,480. You think the difference is $600 a month. You're right. But you think the problem is a monthly income gap. That's wrong. The actual problem is a compounding gap. $600 a month is $7,200 a year. Over 20 years, if you live to 82, which is right at the average life expectancy, the SSA projects for a 65-year-old man, that's $144,000. And that's before you account for the fact that a higher base benefit means higher cost of living adjustments each year, because the COLA percentage applies to a larger number. 2.8% of $1,400 and 2.8% of $2,000 are not the same dollar amount. The gap compounds. According to Smart Assets analysis, someone who claims at 62, instead of waiting to age 70, collects $60,000 less over their lifetime if they live to 85. And the break-even age for the 62 versus 70 decision? roughly 80 to 81. The SSA projects average life expectancy for a 65-year-old man at 84. Women, 87. And for a married couple, there's a 50% probability that at least one spouse lives past 92. So statistically, for most married couples, waiting wins. The math isn't subtle. It's overwhelming. Here's the psychology of what actually happens. You turn 62, the Social Security portal is right there, it's your money, you've been paying into the system your whole working life, and you are staring at $1,400 a month that doesn't exist yet versus $0 a month right now. The brain doesn't process future value well. It processes today. Behavioral economists call this hyperbolic discounting, the tendency to prefer smaller, sooner rewards over larger, later ones. You see it in why people take payday loans. You see it in why people eat the whole bag of chips. And you see it in why, in 2024, 23.3% of women and 22% of men claimed Social Security at 62, the very first month they legally could, according to Social Security Administration data. They didn't analyze it. They just checked in early into the smaller room. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now, here's where this gets significantly worse. You think the problem with retiring at 62 is the reduced Social Security check. That's actually not the primary financial ambush. The primary ambush is the thing sitting between you and Medicare. Medicare starts at 65, period. Unless you have a qualifying disability, the federal government will not cover your healthcare at 62, 63, or 64. That's a 3-year gap. And in 2026, that gap has become significantly more expensive because the enhanced premium tax credits from the Affordable Care Act subsidies that held down marketplace premiums since the pandemic expired at the end of 2020. 5. Gone. The ACA marketplace subsidies that were holding the dam together are no longer there. Here's what that means in actual numbers. Without a subsidy, ACA marketplace premiums for a 62-year-old typically run between $1,000 and $1,800 per month in 2026, according to published premium data. On the lower end, that's $12,000 a year. On the higher end, that's $21,600 a year per person. If your spouse is also pre-65, you're potentially looking at $24,000 to $43,000 per year in premiums before you've bought a single prescription, covered a single copay, or met a single deductible. Now layer in the reality of what's in that premium. It's a bronze or silver plan, probably with a $4,000 to $6,000 deductible. So your $12,000 annual premium is actually the price of entry, not the price of care. You're on the hook for thousands more before coverage actually kicks in. Let me tell you about a guy I know through a mutual contact in the financial planning world. Call him Dave. Dave was a plant manager in Ohio, 58 employees under him, 32 years at the same company. He planned his retirement down to the spreadsheet. He had $400,000 in his 401k and figured he'd bridge to Social Security with withdrawals. He retired at 62 because the company offered an early buyout, and the math seemed fine. He figured he'd pull about $28,000 a year from savings for living expenses, and the Social Security check at $1,400 a month would top it up later. What Dave did not model was the healthcare bill. Dave is a healthy guy, non-smoker, exercises. His benchmark plan on the Ohio marketplace came in at $1,100 a month. His wife was 60, same ballpark. That's $26,400 a year in premiums. He had budgeted $6,000. They were in the hole by $20,000 in year one, not because of a medical event, just existing. Before a single doctor visit, by year two, Dave was pulling $48,000 from his 401k instead of $28,000, which meant his withdrawal rate jumped from 7% to 12%, which triggered a different tax bracket, which reduced the ACA subsidy he did qualify for. A smaller subsidy meant higher premiums, more withdrawal needed, higher taxes, even less subsidy. The spiral has a name, the ACA cliff. Dave's hotel room wasn't 30% smaller. It was 40% smaller because the invisible bill destroyed his cash flow in years when his portfolio needed to grow, not bleed. This is where it gets really interesting, because the healthcare problem connects to something most people genuinely do not think about until it's too late. Knowing these numbers and building a system around them are two very different things. I spent months reviewing 50 years of retirement data, running the actual scenarios across different sequence of returns, environments, and withdrawal strategies. The output was a book I wrote called The Exit Code. It's 8 chapters of pure research, no filler, no motivational language, built around a mathematical framework for turning "maybe someday I'll retire" into a specific date you can defend with actual numbers. 2 sections are directly relevant to everything I'm walking you through in this video. The first is what I call the $14,000 invisible bill, a deep breakdown of the insurance gap between 62 and 65, modeled across income brackets, subsidy cliffs, and the post-2025 ACA landscape. The math there will make you recalibrate your entire retirement date if you've been assuming healthcare will be fine. The second is a Social Security bridge strategy, a specific method for funding the gap between early retirement and age 70 without draining your portfolio, so you capture the delayed benefit without having to keep working. You can get the exit code through the link in the description for less than 1 dinner out. If you're serious about this stuff, and I assume you are, you're 15 minutes into a retirement video on a Saturday. This is the document that replaces 6 months of Googling. Now, back to the mechanism that determines whether your retirement plan survives at all. Stay with me, because this next part changes everything. You think the problem with retiring at 62 is the reduced check and the healthcare costs. You're still not looking at the real problem. The real problem is sequencing. Here's a concept called sequence of returns risk. I'll make it extremely concrete. 2 people both retire with $1 million. Same age, same fund. They earn the exact same average annual return of 5% over 20 years. They both withdraw $50,000 a year, the only difference. One person retires into a good market, one person retires into a bad one. Person A experiences gains in years 1 through 10, then losses in years 11 through 20. Portfolio survives. Person B experiences losses in years 1 through 5, then gains after that. Same average return, same withdrawals. Person B's portfolio is in serious distress by year 5 and potentially depleted well before year 20. The research from Morningstar confirms this. Nearly 70% of retirement portfolio failures involve cases where the retiree's investments had lost value by the end of year 5. Here's why this is a 62 problem specifically. When you retire at 62 with a reduced Social Security check, you need to pull significantly more from your portfolio every year to cover the income gap. You are withdrawing more shares during a period, the early years, when a bear market would do maximum damage. Because when you sell shares during a downturn, those shares are gone forever. They cannot participate in the recovery. The portfolio never fully heals. Now do the math the other way. Every additional year of delayed Social Security is, mechanically, a reduction in your required portfolio withdrawal rate. According to analysts who study this, a $1,000 monthly increase in Social Security income is the equivalent, in terms of portfolio longevity, of having an additional $300,000 invested at a 4% withdrawal rate. Let that land for a second. The difference between claiming at 62 and waiting until 67, roughly $600 extra per month for our $2,000 full benefit example, is equivalent to having an additional $180,000 in savings. You don't have to save that $180,000. You don't have to earn it. You don't have to invest it. You just have to wait. Lazy investing built more fortune than crypto memes. This is what I mean by that. The people who obsessed over yield, who chased every percentage point, who paid advisors 1% of assets every year to slightly outperform a benchmark. They were working harder than the person who understood one structural decision and waited 5 years on a check. Let me introduce you to a subplot that has been quietly running through this entire video. His name is Frank. Frank is 61. He has watched 2 colleagues retire at 62 in the last 18 months. Both smart guys, both reasonably well prepared. One, let's call him Mitch, took the check the day he was eligible. The other, let's call him Pete, had his company announce layoffs 3 months after his 62nd birthday and was forced out without a plan. Mitch did it on purpose. Pete did not, but both of them are now in the smaller hotel room. Frank has been watching this happen around him and doing the math. And what Frank has realized, which I'm going to tell you now, is that the real question isn't when should I claim Social Security. The real question is how many of the 58% are me? Here's the statistic that rearranges how you think about this. According to research from the Transamerica Center for Retirement Studies, 58% of workers retire earlier than they planned. The median age, they stop working, 62. Not because they planned to, because life happened. Health issues, 46%. Employment problems, 43% layoffs. Company buyouts, workforce reductions, toxic situations, family reasons, 20%. And only 21%, barely 1 in 5, said they retired early because they were actually financially ready. So the majority of people who claim at 62 are not doing a deliberate financial optimization. They are responding to circumstances outside their control. A layoff at 61, a diagnosis, a spouse who needs care. And because they are now without income and in the window where Social Security is available, they take the check. They check into the smaller room because the lobby is cold and the credit card is maxed. This matters because of how you should build a retirement strategy. The right question isn't when is the ideal date to claim Social Security. The right question is what is my backup plan if I can't reach that ideal date? Because statistically, you may not make it to 65, 67, or 70 under your own terms. Something, a market crash, a health event, an employer making a decision for you has historically disrupted more than half of retirement timelines. Now, I'm going to tell you something that makes the hotel room metaphor even worse. And this is the fourth layer I mentioned at the top. Social Security itself might be working with a discount code you don't know about. The 2025 Social Security Trustees Report, released in June of 2025, projects that the combined old age and survivors insurance and disability insurance trust funds will be depleted by 2034, 1 year sooner than the previous estimate. At that point, the program would pay only 81% of scheduled benefits. The Old Age and Survivors Insurance Fund alone is projected to go insolvent in 2033, when it would pay 77% of benefits, a 23% automatic cut. And that's before accounting for the most recent legislation. The Committee for a Responsible Federal Budget estimated in August of 2025 that recent changes, including the passage of the Social Security Fairness Act and the One Big Beautiful Bill Act, we have accelerated that insolvency date further, potentially to late 2032, which would trigger a 24% across-the-board benefit cut. Their estimate, a typical couple retiring near insolvency would face an $18,400 annual reduction in benefits. Let me translate this into the context of our 62 decision. If you claim at 62 and take a 30% cut now, and then the trust fund cuts benefits by another 19 to 24% in 2032 or 33, you are not getting 70% of your promised benefit. You are getting somewhere closer to 53%. The small room in the hotel has just gotten smaller again, and this one is outside your control. Here's the dark irony. Part of why early claiming is surging right now is fear of this exact scenario. According to AARP, from January through July of 2025, more than 2.3 million people filed for Social Security retirement benefits, up 16% from the same period in 2024. That's a reversal of a decades-long trend toward later claiming. The Urban Institute confirmed it. Even higher income earners who have the greatest ability to delay are filing at 62 at increasing rates, explicitly because they're afraid the program might change. And here is the problem with that logic. If you claim at 62 and the trust fund runs dry in 2032, you will face the cut on a benefit that's already been reduced by 30%. The person who waits and claims at 67 will face the cut on a higher base. The fear-based decision to claim early to lock in the benefit doesn't work the way people think it does, because the benefit cut is percentage-based, not fixed. The person with the smaller check gets a smaller cut in absolute terms, but the person with the higher base check post-cut still ends up with more. You can't outrun a percentage by making the base smaller. Now, I want to give you the mini case study that ties all of this together. Let's build a realistic scenario. Meet Susan. She's 62. She worked for 28 years as a project manager at a mid-sized logistics company. Her full retirement age, Social Security benefit, the amount she'd get at 67 is projected at $2,100 a month, which is right near the national average. She has $300,000 in her 401k. She lives in Indiana. Option A, she claims Social Security at 62. She gets $1,470 per month. She retires immediately. She needs $1,200 a month from savings to cover the gap in her budget. Plus, she now needs health insurance for 3 years until Medicare kicks in. At a subsidized rate, and this depends heavily on her income, she might pay $700 to $900 a month for an ACA Silver plan. Let's say $800. That's an additional $9,600 a year she didn't account for in her original plan. Her savings draw goes from $14,400 a year to $24,000. At that rate, she's extracting 8% of her $300,000 in year one. In 3 years, she's down to somewhere around $222,000 before any market movement. If there's a 10 to 20% market correction in years 2 or 3 while she's making those withdrawals, she is past the recovery point. She is in the bottom quartile of retirement outcomes. Option B, Susan retires from her main job at 62. She's done fine, but takes a part-time consulting arrangement at 2 days a week, pulling $2,000 a month. That income, combined with disciplined Roth conversion strategies during these lower income years, means she barely needs to touch the 401k. She pays healthcare premiums, but partially offsets them through strategic income management. At 67, she files for full Social Security at $2,100 a month. Her income has now replaced her need to withdraw from savings. The portfolio has had 5 more years to compound at a historical average of 7%. $300,000 over 5 years without withdrawals is approximately $421,000. She then has optionality to wait to 70 for maximum benefits if she chooses, using the portfolio as the bridge. The difference in net worth at age 85 between option A and option B in this scenario is not the $60,000 lifetime Social Security difference. When you add the 3-year healthcare costs, the sequence of returns impact on the portfolio during the drawdown period, and the difference in base portfolio value at claiming age, you're looking at a 6-figure difference. The hotel room metaphor holds same person, same life, same savings, radically different room. Now, I want to interrupt this for a moment with a pattern interrupt, because I have a suspicion about what you're thinking. You're thinking, okay, but what if I die at 74? Then I would have been right to claim early. And yes, that is true. The break-even age for claiming at 62 versus 67 is approximately 78 to 79. The break-even for 62 versus 70 is approximately 80 to 81. If you die before the break-even, early claiming wins. The math is neutral by design. The Social Security Administration built the system to be actuarially equivalent across a normal lifespan. But here's the reversal that changes the whole framing. You think the downside of claiming late is leaving money on the table if you die early. That is the wrong way to model risk. The actual downside of claiming early is running out of money if you live longer than expected. These two risks are not symmetric. Dying early while having claimed early means you get more checks, but you're dead, you can't spend them. Running out of money at 83 is a living emergency. You are here, you are spending, and the check is not enough. One of these outcomes is a quiet statistical loss. The other one is a crisis. The math also changes completely if you are married. When one spouse dies, the surviving spouse receives the higher of the two benefits. That's it. If you both claimed at 62 and both took 30% cuts, the surviving spouse gets the higher of 2 reduced checks. If the higher earner had waited until 70, the survivor benefit would be at the delayed rate. For married couples where one spouse has significantly higher lifetime earnings, the claiming decision for the higher earner is not just about that person. It's about providing a larger income floor for whoever lives longer. And given that the average life expectancy for a 65-year-old woman is 87, and married couples have a 50% probability of at least one spouse living past 92, the probability that someone needs that higher survivor benefit is not small. All right, Frank's back. Remember Frank, who's watching his colleagues Mitch and Pete navigate this from a distance at 61 years old? Frank's key insight, and this is where the subplot resolves, is that the question, when do I claim, is secondary to the question, what are the three conditions under which I would be fine regardless of when I claim? He's building what I call a three-position framework. Position 1, enough liquid savings to bridge at least 3 years of income without touching Social Security and without touching tax-deferred accounts to protect against the sequence of returns window and cover the healthcare gap. Position 2, a part-time or consulting income stream that covers healthcare premiums independently of his retirement portfolio, not because he wants to keep working forever, but because he wants to decouple the healthcare bill from his savings withdrawal. Position 3, a clear understanding of his survivor benefit obligation, meaning his decision about when to claim is made with his wife's longevity scenario, not just his own, as the primary input. Frank is not planning to retire at 62, but he's planning to be ready to survive if life retires him at 62. That is the intellectual distinction that separates the 43% who were employed out of work from the people who, when the layoff came, had the financial architecture to actually wait. 3 practical takeaways, not generic ones, calibrated specifically to the 62 trap. First, calculate your personal break-even age before you do anything else. Go to ssa.gov, pull your Social Security statement, and look at your projected benefit at 62, 67, and 70. Then check your current health status against actuarial tables for your age. If you are in average or better health and have even a reasonable probability of living past 80, the break-even math almost universally favors waiting. This is not financial advice. This is arithmetic. Run your own numbers, but run them. Second, price out the 3-year healthcare gap explicitly in today's $2,026 with the post-ACA subsidy reality. Go to healthcare.gov, model your income at retirement, and see what a silver plan actually costs at your zip code for a 62-year-old. Then build that number into your retirement budget as a hard cost, not an asterisk. If the number changes your retirement feasibility, you now know that before it's a crisis. Third, design your portfolio withdrawal strategy backward from your Social Security claiming age, not forward from your retirement date. If your plan is to wait until 67 or 70, model the withdrawal rate you'll need between retirement and that date. If that rate is above 5% and you have less than 20 years of runway, you have a sequence of returns exposure that needs a cash buffer or a secondary income stream. The retirement industry will tell you to pick an asset allocation. The smarter question is, at what withdrawal rate does my portfolio survive a 25% drawdown in year 3? Lazy investing built more fortune than crypto memes. And the truest version of lazy investing applied to Social Security is this: the people who did the least, who didn't check the portal the day they turned 62, who just waited, who kept the part-time work or held the dividend income long enough to not need the check, those people ended up with the most. Not because they were smarter, because they were patient enough to not be scared into the smaller room. The hotel is still taking reservations at noon. The room is still 30% smaller. And based on the 2025 claims data, more people than ever are walking through that door 8 years early. Don't be the person who finds out the room is smaller by living in it for 20 years. This video is for informational and educational purposes only. Nothing here is financial or legal advice. Consult a qualified professional before making any retirement planning decisions.